Welcome to this deep dive. We're here to break down the latest financial reports, giving you the core insights without the hours of reading. Today, our focus is squarely on Aviat Networks, that's AVNW, and their recently reported Q4 fiscal year 2025 results.
Yeah, and the market reaction here is really interesting. It's almost a perfect case study in, how investors sometimes prioritize profitability, maybe over pure growth, at least right now. The top line revenue, well, it had some wrinkles, actually missed the estimate by a little bit.
Right.
But the profit metrics, the forward commentary, that drove a really significant reaction. Capital flowed in.
A big pop in the stock, wasn't it?
Oh, yeah, over 12% on huge volume. It clearly signaled the market is, let's say, fully bought into management's execution on the margin front.
Okay, let's unpack that split reaction then.
Yeah.
We really have to start with those headline financials. The non-GAAP EPS number, wow, zero number, 83 cents. That just obliterated the street estimate. What was it, around 56 cents?
Yeah, about 56 cents. So you're talking, almost a 50% beat on the bottom line? It's huge.
Absolutely huge. But like you said, keep the balance sheet honest. You have to contrast that amazing EPS with the revenue.
Exactly. Revenue came in at $115.3 million. The estimate was closer to $116.95 million. So a slight miss.
And year over year.
Down just a touch. A modest 1.1% decline year over year.
So flat to down, top line, but exploding profitability. That sounds like operational leverage.
Textbook.
But it does raise a question, doesn't it? If revenue missed, and I think international sales were down a bit.
They were, yeah.
Does the market believe this margin story is structurally sustainable? Or is it just, temporary cost cuts that might hurt them later? Maybe hit R&D?
That's the core tension, absolutely. And I think the answer really lies in the metric that, for me, defined the quarter. Adjusted EBITDA.
Okay.
It hit a company record, $15.1 million. That translates to a frankly phenomenal 13.0% margin.
Record, okay.
And what's really fascinating, this wasn't a one-off, it's a 27% increase year over year, and it marks the third consecutive quarter they've set a new adjusted EBITDA record.
Third quarter in a row. So this ties directly into that M&A story then. They've been integrating NEC Wireless Transport, 4RF. Are those cost savings, that $4.1 million drop in OpEx, is that a direct result of folding those in successfully?
I think absolutely. The integration efforts are clearly bearing fruit, contributing directly to that tighter cost base. These deals were designed to broaden their market footprint, give them better scale.
And now we're seeing the payoff.
We're seeing the structural synergy benefits, and that points towards potentially higher, more durable EBITDA margins going forward, not just a one-quarter trick.
Got it. Okay, before we pivot to the outlook, there's one more financial point we should touch on, a real advantage. Their capital structure. They're sitting on over $450 million in net operating losses, NOLs. For listeners maybe less familiar, what does that huge NOL figure actually mean, practically speaking, for their cash flow?
It's a massive advantage and honestly often overlooked. Essentially, these NOLs are tax write-offs from prior years. Huge ones. So the practical value is it shields them from paying significant corporate income taxes for, the foreseeable future.
Minimal cash tax payment.
Exactly. So you combine record EBITDA performance with minimal cash taxes.
Yeah.
That massively boosts future free cash flow generation. And that's incredibly attractive for investors focused on cash returns.
Okay, clear advantage there. So if operational discipline was the story of Q4, the backlog gives us the first real glimpse into the story for the next year, right? Fiscal 26. This is where we shift to the forward view. And those backlog numbers, they look pretty exceptional.
Yeah, that backlog number, you could argue, is the single most important data point from the entire call. Total backlog grew 11% year over year, came in at $323 million.
11% growth. That's strong.
It is. And crucially, their trailing 12-month book-to-bill ratio was over 1.
Meaning they're booking more new business than they're delivering in revenue.
Precisely. So despite any, lumpiness in current revenue, especially the timing of some of those big international deals, the underlying demand signal is strong. They are winning business, building that future revenue stream. It really sets them up for potentially very robust fiscal 2026.
All right, so where's that demand coming from? Let's break down the segment mix. North America revenues look decent, $58.0 million, up about 3.2% year over year. What drove that?
Yeah, North America's strength is almost entirely coming from their exposure to the private network space. That's the key driver there.
Okay, private networks.
Conversely, international revenues were $57.3 million, but that was down 5.2% year over year. Management chalked that up mainly to timing on large mobile network projects. You know how those can be, they often fall into one quarter or the next, a bit unpredictable.
Sure, lumpiness.
So the takeaway really is stability and growth in that high-margin private network segment, which is offsetting some volatility internationally.
Okay, let's double-click on those growth drivers management talked about. Starting with private networks, what specific trends are fueling that stability and growth you mentioned?
They're really benefiting from two major trends there. First is public safety. Strong demand for upgrading LMR networks.
LMR being land mobile radio for first responders.
Exactly. Critical communications networks, they need significant upgrades to handle modern things like video, more data traffic. Aviat is right in the sweet spot of that spending cycle. Management even pointed out that state and local public safety budgets expected to grow 5% to 8% for fiscal 26.
That's a nice tailwind.
Definitely. And second, there's critical infrastructure demand. Think utilities, oil and gas companies. They're upgrading their essential internal networks too.
Okay, makes sense. Now, shifting over to mobile service providers, the MSPs, you mentioned a rebound in U.S. Tier 1 spending in Q4, and they hit a milestone too, right? $140 million annualized revenue for the PathLink portfolio. What is PathLink, and why does that target matter?
Right, so PathLink is basically their flagship product line. High-capacity microwave radio, primarily used for backhaul connecting cell towers, hitting that $140 million annual target. It's important because it validates their scale, their market share leadership, particularly in that U.S. Tier 1 market. Looking ahead, they also talked about future opportunities in emerging market 5G build-outs. You know, places still early in their connectivity cycle where microwave backhaul is often the quickest, most cost-effective way to expand coverage.
Got it. But the elephant in the room, the biggest future opportunity they discussed has to be BEAD funding, right? The Broadband Equity Access and Deployment Program from the government. Management was explicit, though. BEAD will not impact their fiscal 26 guidance. Yet they sounded really, really bullish on it. Why the disconnect?
Yeah, it's a key point. They're highly encouraged by something called technological neutrality that states are adopting when awarding these contracts.
Technological neutrality.
And it's not just about fiber optic cable anymore, which was the traditional focus of government broadband funding. States are now open to awarding funds to wireless solutions, fixed wireless access, or FWA. And those solutions rely heavily on backhaul technology like Aviats.
And we saw actual examples of this, right? They mentioned states like New Mexico, Washington, Kansas.
Exactly, awarding huge portions, like 40 to 50% of the locations being served, to wireless and FWA solutions. That's a fundamental shift, a game changer for a company like Aviat.
Okay, so it's a structural shift in their favor.
Highly favorable. Now, they still think meaningful revenue impact won't really hit the books until calendar year 2026, just because government deployments can be slow to roll out.
Right, bureaucracy.
But the writing's on the wall. They're really well positioned to capture a significant slice of this massive infrastructure spend when it does start flowing.
Okay, so let's put it all together. Profitability is strong, record EBITDA 3 quarters running, backlog is growing 11% year over year, book-to-bill over 1. You've got this massive BEAD tailwind coming, even if it's a bit further out. So why? Why is management guiding so conservatively for fiscal year 2026? There must be some execution risk or something tempering that outlook.
Well, there are a couple of things. First, they did note, and it's important, that they still have material weaknesses in internal controls. That requires ongoing investment and remediation work. So that's certainly a factor, adds a layer of caution.
Okay, internal controls risk, serious, but maybe manageable.
Hopefully.
Yeah.
But the explicit reason they gave on the call for the conservatism in the FY26 guidance, which was revenue $440 to $460 million and adjusted EBITDA $45 to $55 million, was more strategic. It related back to Q1 performance a year ago.
They cited the underperformance of Q1 last year.
Precisely. Management basically said, look, we want to, and I quote, prove ourselves one more quarter before potentially raising the outlook further. They're essentially managing expectations down, particularly for the first half of the year. They know their underlying fundamentals, that backlog, the cost savings are probably stronger than the current guidance implies.
And they also talked about seasonality, right?
Yes, confirm the historical pattern. Q1 is usually the lowest revenue quarter. Revenue builds through the year, making it much more of a second half weighted story. Q4 tends to be the strongest.
So, reading between the lines, it sounds like a pretty clear, deliberate attempt to set a low bar. Maybe even, dare I say, sandbagging Q1 a bit, setting themselves up for a beat and raise cadence throughout the year.
That's certainly the interpretation many took away from the call. They've given themselves a substantial cushion. It allows them flexibility to manage that internal controls risk, deal with any Q1 lumpiness, while still being very bullish on the overall operating environment.
All right, well, this tees us up perfectly for our This Is Not Financial Advice segment. Based on everything we've just dissected, the leverage, the backlog, BEAD, that very conservative guidance, what's the outrageous but plausible trade idea you'd pitch to the investment committee?
Okay, NFA disclaimer firmly in place. The titch is a high-conviction long on AVNW. The core idea is to capitalize on what looks like the near certainty of a significant guidance raise, probably by the middle of fiscal year 2026. Look, the current FY26 guidance just feels mathematically conservative. The midpoint for EBITDA, $50 million. That's only slightly ahead of their current run rate.
Despite 11% backlog growth.
Despite the backlog growth and despite the fact that it includes absolutely zero contribution from BEAD funding, it seems low.
So you're not just betting on a beat against the current guidance, you're betting on management eventually having to admit the real floor is much higher than the target they've set out publicly right now.
That's the thesis, yeah. Private network demand, fueled by those LMR upgrades we talked about, plus the full impact of the operational synergies kicking in, that should drive first half profitability that easily hits the high end of the current range, maybe even exceeds it. But the real catalyst, the things that could really move the needle later in the year, are the BEAD funding starting to become more concrete, maybe driving actual orders in the second half, and that typically strong Q4 seasonality kicking in.
Okay, so if that's the thesis, what are the mechanics? How do you structure the trade to capture this sort of multi-year story?
Given the time frame, especially with BEAD being more of a calendar 26 impact, we'd look at using long-dated call options, something expiring well into fiscal year 2027.
Give yourself plenty of runway.
Exactly. Enough runway to capture the full multi-year arc here. This is about their repositioning, right? Moving from maybe being seen as just a niche microwave vendor towards becoming a scaled, higher-margin transport and access platform. We're essentially banking on a significant re-rating of the stock once that Q1 conservatism is behind them, maybe by mid-fiscal 26, and the true scope and timing of the BEAD opportunity become clearer.
Okay, fascinating idea. So wrapping this up, what does this all mean for you? Listen again. Aviat Networks, AVNW, delivered a very clear EPS beat, record EBITDA, signaling that their M&A integration is working, operational leverage is kicking in, and they did this even while managing a slightly soft revenue quarter, mostly due to international project timing.
Yeah, the key takeaway for me is the confidence. Confidence shown in that growing backlog and the real structural improvements in profitability that management has clearly executed on. It really does set the stage for a potentially explosive second half of fiscal 2026, especially if they meet or more likely exceed that highly conservative guidance floor they've set.
We definitely encourage you to dig into this material further. Maybe look into those state beat allocations we mentioned. See how wireless is factoring in.
And maybe here's the final provocative thought to leave you with. Given how aggressive and, frankly, effective management has been on cost discipline, remember that year-over-year OPEX reduction and their proven ability to navigate tricky things like supply chains and tariffs, will the market start assigning a significantly higher valuation multiple to Aviat, faster than people expect? As it transitions from just a microwave equipment vendor into this high-margin scaled transport and access platform, if they keep delivering this kind of profitability, their valuation could start looking more like other high-growth infrastructure plays, maybe sooner rather than later,